What's going on, everyone? Lalit here. America, as well as the whole world, whether we like it or not, runs on credit. And to not have a good or excellent credit score can mean a few things. It could mean burning money to unfavorable interest rates. It could also mean not being able to take advantage of some amazing investment opportunities. And in the worst case scenario, you may not have a potential solution in an emergency situation without this good or excellent credit. And of course, one can live without a credit score, but in today's financial world, it mathematically makes more sense to have one versus not. And if you feel you have that much cash and you'll never need a credit score, then I'm going to drop my Cash App and Venmo in the description below and look forward to seeing some funds come through. No, I'm joking. But with that, today we'll be getting into 5 credit mistakes to avoid, which could obliterate your credit, which not only impacts your short-term financial future, but your long-term outlook potentially as well, and potentially your future lineage. So with that, we'll get straight into it. So first on our list is being afraid of getting a hard inquiry on your credit report. It affects around 10% of your score, and you always see these hard inquiries come up on your report whenever you're asking for credit. And there's a difference between soft pulls and hard pulls, where basically a soft pull is where your Credit Karma, where you can actually check your score and kind of see how you're tracking. But hard pulls, when you apply for a mortgage, when you apply for an auto loan, when you actually apply for a new credit card, basically this hard inquiry is what folks are afraid of. I don't know where it started, but the urban legend slash myth, it's always like, oh my gosh, I don't want to run my credit because it's going to affect my score. And realistically, yes, it's going to take a short dip of maybe a couple points here and there, but after around 6 months, it kind of comes back to where it is all else equal. And every 2 years, basically all your hard inquiries are dropped from your credit report. And to be clear, it's a rolling 2 years. So for example, if you apply for something today and get a hard inquiry on your report, then 2 years later, it's going to go away from your report that, hey, you tried to get XYZ amount of credit line. And let's say next month you applied, then 2 years and 1 month from now is when that second inquiry would go away. Overall, hard inquiries without actually asking for credit and then getting more credit and then maintaining a good repo, basically that's keeping up your score for today and tomorrow. And so it's just a process of going through and getting that hard inquiry on your report, but there's no reason to fear. And a last tidbit over here before we move on to the second mistake is that when you're actually rate shopping, for example, looking for a mortgage, or if you're thinking about refinancing a property, then within a 30-day period, you can actually ask multiple times to different lenders, hey, can you run my credit? Because after you run it once, it'll be a hard inquiry on your report, that's correct, but you can get the best rate without feeling that, hey, they're going to run my report over here, over there, and somewhere else, and before you know it, you're checking out 5-10 places, and the fact is you're not going to have 5 or 10 different checks on your report. It's just going to be one hard inquiry, so this way you can get the best rate. Moving on to our second mistake, it's going to be canceling credit cards or lines of credit. Canceling certain items which comprise of your credit score could actually affect one of the portions of your credit score known as your age of accounts, which comprises of 15% of your overall score. When you have a credit card for 10 years, and let's just say you only had one credit card, and let's say 10 years later you open another credit card, what's going to happen is that you have 10 years of history on one credit card, and you have now this new credit card today of 0 years in terms of history. And so your age of accounts is going to be 10 years plus 0 from today, and divide that by your total number of credit cards, in this case 2, or lines of credit as a whole, and we'll assume it's 2. So 10 divided by 2 means your average age of credit goes down to 5 years. The point here being that if you have, let's say, 3, 4, or 5 cards, and let's just say you're not using them, and so you think, okay, let's just go ahead and cancel them. In fact, these may be the foundation of why you may have a very good credit score, because there's age, there's history, there's quote-unquote experience, which your credit report shows by having these lines of credit slash credit cards. One of the most common situations that I see is folks getting a department store credit card, which after they get, for example, 20% off their first purchase at Macy's or JCPenney or wherever, what happens is folks don't use it. So after 6 months, a year goes by, and you're not really using it, you're like, okay, might as well cancel it. But what you're taking away actually is not only the age of credit in this situation, but it could also affect your credit card utilization. Credit card utilization is how much credit you've used divided by how much credit is available to you. For example, if you have $2,500 available on a certain department store credit card, and let's say you're not using it, so you're not utilizing it all, so it's 0% on that card. But from a credit score perspective, how it works is it takes in your total line and your total usage as a whole. So looking at the bigger picture, let's say you have $2,500 that you're using in terms of your total $5,000 credit line. This means a 50% credit card utilization. And let's say that the department store card you have is $2,500 of that total $5,000 credit card line / total credit that you have available to you. Like this, if you have 2,500 that you're using divided by 5K, then that's 50% credit card utilization. But if you cancel that department store credit card, then you're taking away 2,500 of that 5,000, so you're going to be looking at 100% credit card utilization. I'm going to use this point of credit card utilization to segue us into the third mistake, because credit card utilization makes up 30% of your overall credit score. The third mistake over here is basically dealing with balance transfer cards and those promotional periods of 0% APR for some time, and then after that, it's basically back to normal interest. The mistake over here is not actually doing the balance transfer, because depending on the situation, it could make more financial sense to buy yourself some leeway of having 0% for X amount of time. The issue is there are certain products and certain predatory products out there which basically may give you that 0% for some period of time, whether 12 months or 15 months. But the issue arises where within those terms and conditions are ingrained real language such as, if you do not pay the amount you balance transferred in full after the promotional period, then we will charge you interest from day one. So the issue with this is that maybe it's a product that someone didn't really think they were really signing up for. And so lo and behold, after that promotional period, now you have a higher balance. And more importantly, even if you want to buy yourself some real time this time, because now maybe you know the rules, you may not even be approved for another balance transfer. Your credit card utilization would also be higher, just all else equal. And so this is just going to be a compounding problem for not just the financial situation from a dollar amount perspective, but your credit score as a whole. The fourth mistake is not knowing the difference between late payments and missed payments. This would impact the payment history section of your credit score, which makes up 35% of your overall credit score. For example, if a bill is due today and you pay tomorrow, even though it's officially late in the way we use the word late, a late payment isn't considered late until it's 30 days after the payment due date. That was a lot of times saying date over there. But overall, if you're going to be late or you think you're going to be late or some issue may arise, basically after 30 days, the lender themselves can report to the credit bureau, which will impact your score directly. So if there's some issue, it's better to let them know than not. Missed payments, on the other hand, are just as they sound. They're totally missed. You're not doing them. And if you don't pay once, twice, and after a certain period, usually 180 days, it goes to a third party, aka collections, and they try to get that same debt that's owed to the initial lender, but they try to collect on their behalf. Whether it's missed payments, officially late payments, items going to collections, or repos, aka repossession, which is really common in the auto industry, basically these are going to end up as derogatory marks on your credit report. Derogatory marks stay on your credit report for 7 years. And so for 7 years, you're always going to have that mark on your credit profile. And even if your score looks good, if any underwriter is looking at it, depending on what you're trying to do with your credit score as a whole, that derogatory mark is going to show. And to have 1, 2, 3, 4, it adds up quick and it really tarnishes your credit score as a whole. Last but not least, it's a mistake of its own. It affects 10% of your score, but it's basically not having an overall mix of different types of credit. It's considered by credit score and credit score standards that the more mix you have, the better. So what that means is, for example, a line of credit, which is just a personal line of credit. Then maybe you have a credit card. Then maybe you have a home loan, maybe a car loan, items like this. And so they just look at this like, okay, there's different types of way this person's borrowing, and seeing how they pay back and their track record, their track history, etc., you're basically getting at this mix, which it affects 10%. And let's just say you only have one credit card. In my honest opinion, it's always better to have more kind of options, whether you need credit or not. And it also shows for the report itself for whenever you do want to utilize your own credit score, because that credit score is yours and is there to be used, and it's basically your right. And so why screw up something when you don't have to? But more importantly, it's about having a good and excellent credit score, which leads to that next step for that short-term financial gain as well as long-term financial gain, and it could help those around you as well. It's getting pretty hot here in India, but you know how it is. Thanks for watching. See you soon enough. Peace.